Steve Leone. We're at Intersolar 2012 in San Francisco. I'm here with Shayle Kann of GTM Research. Thanks for joining us.
Thanks, Steve. Good to be here.
So you released probably about a couple months ago the Q1 figures that showed some pretty strong growth, probably even more so than had been projected, which caused you to push up the projections for all of 2012. What's 2012 looking now, a couple months removed from that?
Right. It looks pretty good, actually. We had in 2011 and 2010 both, the market more than doubled relative to the previous year. This is specifically the PV market in the US. And so we were coming off of 2 years of doubling market, which is tough to repeat. And we don't think that we will repeat it this year. But our current forecast is that we'll see about 3.3 gigawatts of PV installed and completed in the US this year, and that results in about a 75% growth rate over 2011, which is still a pretty strong year relative to where the global industry is heading. So I think all things equal, the US is on a good trajectory for the rest of this year at least.
And the second half of the year is going to be defined a lot by the large-scale utility projects. What does that market look like going forward beyond 2012?
Yeah, we're in an interesting point of flux, I think, in the utility market in the U.S. We have about 1.5 gigawatts cumulative operating. That's utility scale PV. Mm-hmm. So that's, it sounds like a big number, but 1.5 gigawatts, that gets installed in a month in Germany periodically. So it's still pretty small. But if you compare that to the pipeline, we have well over 4 gigawatts in construction. We have 10 gigawatts of projects that have PPAs between utilities and developers, just waiting for permitting, interconnection, financing, construction. And then we have maybe 35 gigawatts of later stage projects that don't yet have a PPA. So there's this enormous pipeline to be worked through. But I think there's sort of divergent trends. If you're looking at installation totals, the next few years are going to look huge for utility scale in the US. Mm-hmm. There's just so much in construction, and so many of these projects that have PPAs and aren't yet in construction actually look pretty good, especially given that prices have fallen, debt rates have remained pretty low. So we'll see a lot get constructed. But on the other hand, as far as new development goes, it's a tough time to be a developer right now. Utilities aren't signing more PPAs than they were last year. Natural gas prices have had an impact on that outside of RPS standards. And so there's a lot of stranded assets out there in the earlier stages of the pipeline. And that's why we've seen a fair amount of acquisitive activity amongst projects and project developers.
Okay. Now, moving forward a little bit to 2013, really, as you've said, we'll start to see the impacts of the trade case, and especially 1603, which expired. What's gonna push 2003 ahead? I mean, we're still talking about a 3 gigawatt market, right?
Right. And to be clear, we anticipate that 2013 will continue to see growth. It's actually really hard to envision the U.S. market shrinking year over year anytime in the near future. So the question is, how big is the growth rate? And we've unfortunately become accustomed to these enormous growth figures. Mm-hmm. So if we saw 25% growth next year, that would look like a bad year. Mm-hmm. That said, there are a few factors that are going to be at play in 2013 that could potentially dampen growth a bit. I think the trade case at this point looks like it's not going to have a huge impact on overall market dynamics. It obviously has an impact on manufacturers to an extent, but for the most part, major manufacturers have figured out how to deal with the tariff. Either they've had a cost impact that has resulted in slightly higher incremental prices relative to what they would have been, or they've gotten around the tariff another way. Either way, I don't think that that's going to have a huge impact on the market next year. But the expiration of 1603 and the fact that we reverted back to a tax equity market, that will have an impact. And it's not yet because there was so much safe harbored capacity, basically projects that are still qualifying for 1603 getting built throughout this year and even early next year. So later in 2013, we'll start to feel that tax equity bottleneck. And that's the big question, is how much of a bottleneck is that? How many new non-traditional tax equity investors will they be able to find? And how much volume can they do? Because that's really the constraining factor to many developers right now.
Okay, so why in 2014 and 2015, those, a little farther down the line, we're seeing a return to pretty healthy growth and in fact, a very vibrant market. What are the underlying factors you're seeing there?
I would say that there are 2 or 3 fundamental factors that we think result in longer-term, sustained, impressive growth in the U.S. market. The first, let's go back to the financing piece with regard to tax equity. The first is that we'll see the new entrants in the tax equity market. It takes time to get them comfortable, to get them involved in the market. This is companies like, Apple, companies that have big tax appetite, sitting on a lot of cash, could be tax equity investors, just haven't done it yet. So there are a lot of developers working on getting them into the game, and it'll start to happen. Related to that as well, we're also looking at the possibility of a number of new financing structures that could significantly drive down the cost of capital. This is things like solar REITs, master limited partnerships, and a number of other financial innovations, crowdfunding solar like Solar Mosaic is doing. So I think the first thing that'll happen is financing hopefully will get easier. The second thing that'll happen is costs will continue to fall for projects, and we're very close to the point where in a lot of places we don't really need state level incentives anymore. And once you get past the point where you need things like state rebates or production-based incentives, then the market can become much more vibrant, much more sustainable, and a lot bigger. And so that's the next phase of the market. In California, once the PBI runs out, will there be a market after that, and how big will it be? Once that becomes self-sustaining, there's, relative to today, there's basically limitless growth potential.
Okay, well, what does that do to once we get past that post-ITC period, what does that look like?
That's harder to call, right? So the ITC goes through 2016, so we're talking about 2017 onward. And it's not a foregone conclusion that the ITC doesn't get renewed, either in its current form, a 30% tax credit, or potentially as a step-down function kind of a thing. And so we may see a slow removal of the ITC as opposed to an immediate January 1st, 2017, it gets removed. But even working under the assumption that it does get removed at the end of 2016, I don't think it kills the market. It certainly hurts the market. There's no question about that. You've added 30% cost to every single project. But by that point, cost should be such that there are projects that still make sense without the ITC. I think, if we're smart, what we should do ultimately is not remove the ITC, just have it gradually decline to the point where we don't need it anymore. That'll allow the market to continue ramping up while we wean ourselves off of it. But, it's all dependent on political reality.
Okay. Well, thank you, Shayle. Thanks for stopping by. Enjoy the rest of the show.
Anytime. Thanks, Steve.